Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hi, everybody. Welcome to the show. So on today's episode, I have a very special guest with me, Max Holvik. I got connected with Max through a mutual industry, big person who I'm not going to name. And Max's specialty is doing fractional CFO work for RIA firms. So we naturally connected just because of being on the financial side of working for firm owners. And, it's interesting. I found a lot of the time, Max, people don't understand sometimes the difference between internal accounting and external accounting and tax work. But welcome to the show today. Thanks for coming on.
Thank you. It's an honor to be here. Thank you for having me.
Yeah. So, like I mentioned, we both work with very similar types of firms and firm owners. There's so many places we can go in this kind of conversation, but something we were talking about in the pre-show that I think is a great place for us to start is I find with a lot of advisors, their background prior to being a firm owner is for a lot of them, they are really trained up on technical financial advising, on business development, on client relationship management, even on like people management. But I find for a lot of firm owners, the having to step into really an executive function role where now you've got an organization underneath you that's growing, maybe especially for advisors where like their team is growing and they don't have that same day-to-day visibility on what's going on in the firm. There's a very natural shift that happens with all of a sudden financial reporting becomes very, very important. So on today's episode, I thought we could discuss a little bit of, for those of you in the audience who are very seasoned with reading financials, I appreciate you being here, but we're going to try to talk, at everybody's level, because I know when I've worked with firm owners, I have some where they don't know how to read their financials. They don't even know that they need financials. And then I have other firm owners who are, they're doing KPIs, they're tracking things meticulously. There's, they have really specific accounting processes and review processes that they use strategically. So you get a whole spectrum of how people use their financial data or states of financial data. So I guess to start us off, Max, just one question. So for any advisor, so say we're talking about somebody who's a startup, why is it important to have financials, and like what's the bare minimum system that they should be having in place for accounting, would you say?
That's a good question. And it obviously depends on what stage you are at, but I think even from the very startup, without good financials, you're flying blind. So it's you got to have good financials. The numbers got to be correct. Doesn't mean to be sophisticated, but they got to be correct. And I think even for a startup firm, getting monthly financials is important. The related to having good financials is obviously separate your personal finances from that of the business, as I'm sure you've seen at times is not happening.
Yes.
And a good chart of account as well, especially when you start looking into making decisions on the financials. It's important to have a chart of account that gives you the information that the owner and the principal can use in making decisions based on the financials without it being too cluttered. Obviously, as years go by, you typically see a business having lots of different accounts that were created over time and may have made sense at the time. So taking a step back here, I think for a startup, think a little bit extra on how you want to set that chart of account up, so it helps you making decisions. And then for a firm that has 5-10 years of history and maybe a very cluttered account, it may make sense to do a little extra work and change the chart of account to something that makes sense for you and how you make decisions. And regarding what you mentioned in terms of explaining things, chart of account, for those who don't know, is basically the setup of your accounting books. Like what accounts do you have on the P&L, on the income statement, that is, and what accounts do you see on the balance sheet, and they should make sense to you. And
Yeah, and
yeah,
I would agree with you, Max. Like, I think the first place I usually start people on when they're a startup is like, you have to have a separate business bank account. You have to have a separate business credit card, because a lot of the times with the record keeping, it can be done retroactively, you know, especially in those really early days where you're just, especially if for like solo advisors, you're in survival mode, right? Like, you don't have a lot of support, you don't have a lot of infrastructure. The accounting is something that can kind of wait a little bit. You know, versus things like you got to sell, you got to get revenue in first, right? So but if it's all commingled, it's impossible to then try to turn that back into actual accurate record keeping for tax compliance purposes. So it just ends up being like a disaster. So if you get that, and then a lot of people will ask me too, because if they're, you know, we have a lot of people who listen to the show who aren't RIA. And so they earn their income where it has to be deposited to them personally. So usually I'll recommend for people that have that setup is like, you still want to have a separate bank account that's in your personal name if it has to go to you personally, but that is only receiving that business income and having business expenses to it, or, you know, whatever your structure is. But that's if people only take one thing away from the show, that's a win. Of just it's called commingling funds, and
I agree.
It's really tough.
Couple of hybrid clients who's in that situation, and having that brokerage bank account, only do that and not mingle it with your personal stuff is critical. And I want to add to in terms of what I think is in terms of good financials, and this may a little bit more of firms who's gone beyond the pure startup phase, is being able to link your financials to your future goals. I think there's a lot of extra insights and benefits to the organization to do that.
Yeah, absolutely. And so I guess, you know, when you start working with firms, what are some of the things that you're looking at first that you see as like common errors or common issues, or common things that tends to need correction when, you know, you start working with somebody for the first time?
Yeah, there's some common themes, but every client is different. How I typically work is that I do a deep dive, 2 to 3 weeks of a diagnostic package, where I basically give a full review of the financials and my recommended goals of what to do, as well as a roadmap for the next 90 days. And that will usually reveal what the particular clients need. Typically what I see is it could be, well, a lot of it is client profitability. So firms don't necessarily know the cost to serve. And considering the fact that about 2/3 of the RIA's P&L tend to go to payroll, it's really important to have a good grasp of what does it cost to serve the different clients and client segments. That's a big one. M&A, a little bit on the exit side, but I see it more on the acquisition side. It could be a owner who never done an acquisition before, and first of all may not have the bandwidth to do the needed due diligence, but also not really sure how to tackle it and see what the risks involved in that process. And then other items could be that needs to have a better capital structure in terms of a loan that may be outdated at a high rate or bad terms. Maybe we should renegotiate that. And just financial transparency.
Yeah, no, those are all great points. I want to zoom in a little bit on the basically like that unit economics of client profitability, because I find with a lot of advisors, you know, one of the questions I'll often ask when I'm first kind of getting to know a firm is, okay, so how many households do you serve? Like, what's the typical size per household? You know, and it's interesting, like once you've got those two metrics and then you've got the payroll number and the revenue number off of the P&L, it tells you so much about kind of what's going on internally. And I find that that's something that a lot of firm owners, like they've just never kind of triangulated those relationships, even at a macro level. So maybe to zoom in a little bit more on that, you know, for firm owners who say, you know, don't have a fractional CFO behind them, how would you recommend they kind of approach that topic, and look at that
Yeah.
and be able to see that better.
Yeah, and sometimes maybe that makes sense to engage. Sometimes you could do it yourself. And it's not really rocket science, but it's often it takes a little bit of extra time. I would start at the high level. Just what's your profits, and what's your operating margin like. Break it down further to what's revenue and profit per advisor, and what's revenue and profit per client. That gives you at least a high level figure. Compare that with how you've done in the past to see if you're improving or deteriorating. Also compare some of those numbers with benchmarking studies out there. Like Kitces has a lot of good stuff. You got the Schwab Impact study and so on. Some of these are a little more nuances to it, so pure benchmarking doesn't work. But at least you kind of get the lay of the land of where your business is. So benchmark to yourself and benchmark to the industry. And then the real work is digging deeper. I dare to say a lot of firms don't track the time that each employee spent on each client. So the ultimate goal would be in your CRM system, you're able to track this to see, hey, for this family, this is what it cost us to serve that client. And I can compare that with the revenue figure. That's where you really want to go. Short of that, I would say start at the high level figures. And if there is a way to at least take some of the overhead costs and allocate to what's driven by client activity, that will get you partially there.
Mm-hmm. Yeah, no, that's great. And I appreciate that you mentioned the time tracking too, because that's something that, I know for a lot of people when they go independent from somewhere else, that's one of the first things that can fly out the window because it's a grading process. But I usually recommend the same thing for people because especially, with these smaller firms and for the firm owner, a big piece that I'll find that often can be skewed in these kinds of calculations is the owner doesn't account for their own time correctly.
Yeah.
And then also they don't account for their own value correctly. And so I'll see these like unit economics where they're like, oh, we're so profitable. And then I look at, well, how do you compensate yourself as an owner? And a lot of times what we're required to do from an IRS perspective will be far, far lower than what, if we really truly were to replace that person and replace the key advisor, the owner advisor, we would have to pay more than what the IRS required minimum is. And so you can get this phantom effect where you think your business is really profitable, but it's missing your own compensation out of that number, especially for people who are like S corporations where, we're trying to show more profit on the S corporation side because it's more tax efficient, but it's not actually representing the unit economics correctly. And so it can be easy to think you're performing great when it's actually like, no, once I add you back in here, to replace how competent you are, now we just lost 500K of profit, like whatever it is, right? So that can be another issue. And I think one more point too, with the time tracking that, even for owners, I think it's really important to track your time is like a great measure over time is like, where are you spending your time and how valuable is that? And are you spending time on things that aren't valuable, like admin, or fiddling around in your QuickBooks or things like that, where it's, versus the time that you are. But then especially like for team members too, I know this becomes an issue is being able to capacity plan correctly. Because I know for a lot of the firms we work with, like they're growing hand over fist like every year, just because there's not, we're running out of advisor talent in the industry in a lot of ways. And so if nobody's tracking their time, how do you know how much capacity you have to take on new clients or to serve the existing clients? And then also just to track efficiency, right? Like if you've got one team member who's able to do double the load of somebody else, like you want to be aware of that. So I guess for advisors, what are some common mistakes that you see when you go through your diagnostic process, or things that maybe should be red flags, or like some of those gotcha moments that people find surprising, if there's anything that sticks out from your experiences? Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
Well, one of them is related to this whole cost to serve, and yeah, you're bringing up some great points on it's having that insight not only give you an understanding on the client profitability, but also how efficient are each individual advisor, and are you at below or above capacity, and being able to plan that way. So I think one mistake is often thinking that your largest client is automatically your most profitable one. And
True.
I've seen this in the past where you actually do the work and it turns out that this big client, maybe you get a ton of different requests pulling all kind of people in different directions. And when you run the numbers, they're sometimes even unprofitable versus that smaller client who don't take that much of your resources and end up being more profitable. Now, you're probably going to have a mix of both, but having that insight is then able to see what clients do we want more of, and for those clients that are less profitable, are there a way that we can make them more profitable, either through to service levels or pricing. So I would say, yeah, assuming that the biggest client is the most profitable is one. Another gotcha is thinking that because your revenue grew, you're doing good from a growth perspective. But
Yes.
we've seen 10, 15 years of amazing market growth. And what's the latest number I've seen? Less than 2% organic growth in the industry. So digging under the hood there and seeing what is actually organic growth is critical. And that even, if you're looking at selling at some point, firms with organic growth typically have a higher multiple, all else equal, than those that don't have that organic growth. And I guess a third one to add to that is on the M&A side. If you're looking at an acquisition, I like to say there's three main mistakes that you can make in an acquisition. Obviously, there's tons of different things you got to look at and things that could go wrong. But the first one is that you miss out on an important acquisition because you weren't prepared for it. You didn't have the time to do the due diligence. You often showed off as being less of a serious or professional buyer, and that scared the seller away to make a deal with you. The worst one is you overpay for an acquisition, and the absolute worst one would be you do the wrong acquisition, typically from a wrong cultural or strategic fit.
Yeah, no. And I guess maybe to speak a little bit on this side, because I work in a lot of casework that's like this, and it's always interesting to see kind of what current pricing is out for different practices when people are buying and selling. And, I think when it comes to some of that due diligence work, if we have an advisor who's maybe looking to acquire another book of business, what are some of the things that you recommend looking at when they're going through that process that they may not be aware of?
The first one I would start with is first of all, if you're buying a practice, or even with you're buying a book of business with a certain type of clients, is this a cultural fit? Is this something that you want to bring into your business? And does it make strategically sense based on where you want to take the firm? Then digging into the numbers, it's there's so many variables, but what's the recurring revenue? There's a big difference between a brokerage side of the business versus the recurring revenue on the RIA side. If you're buying a hybrid, the demographics of the clients, a book with an average 40 years left to be a client is different than if you're taking on a business of people only in their 70s and 80s. Obviously, they got to be served as well, but as a buyer of that business, you'll probably pay less than if you had a lot of people in their 30s and 40s. Those are things. advisors and how the stickiness of that relationship. It's I mean, you could buy a practice and the next day, if the advisors walk out on you, you have no business. You just paid a lot. So I mean, there's as you know, there's so many parts to due diligence, but I would say start with a cultural and a strategic fit, and then as you dig into the financials, look at the quality of what you're buying, and keep it in mind too that we see these multiples of it's like 8 to 15 times EBITDA is what you keep hearing currently.
Yeah.
I know someone looking at the 22 times EBITDA, which is unheard of from in many other industries. But we also forget that 3/4 of every deal tend to fall apart, often because the business is not ready to sell. The business is too reliant on the owner. And actually, that's when I should have started with if
huge problem.
Yes, that a lot of the multiple or even the ability to sell goes to how will this business do when the owner steps away.
Yeah, and how willing and able are they to participate? Because I see a lot of advisors where they wait too long, and then it's, okay, well, if you want to sell this business, but you're still completely integrated in these relationships, what happens? You get the spouse with the cancer diagnosis, or you have a health incident, or whatever it is, right? Like this business just isn't robust. Like you've got some serious risk there. And another point that I like to mention, because it's a really common gotcha on my side of the fence with the M&A work, is a lot of times, so I work with a lot of people who are doing internal succession. So it'll be a first generation selling to employee advisors, or like family members or whatever. And so for people who are on the buy side, something that's really important to remember or just to be aware of is that there's a really big distinction between if you're doing a stock acquisition of a practice or if you're doing an asset acquisition of a practice.
Absolutely.
Because if you do a stock acquisition, you get zero write-off every year for the principal of that practice because it's just stock basis, versus if you buy the client assets and the goodwill, you get 1/15 of it every year typically. Yeah. And that makes a huge difference for taxes depending on how big the practice is. So for a lot of people, like something that we'll end up doing when somebody's thinking about buying into a practice, or, more typically we're involved with internal succession, is, okay, for how much they want to sell it for, if we're going to have this additional tax hit because it's a stock acquisition, is the business profitable enough that it can pay for its own acquisition through to the new owner, accounting for taxes? Because typically what ends up happening is, the business will have a certain amount of profit. The new owner has to pay the old owner, if it's seller financed, or, the bank, that principal portion for the year plus interest. And typically the bigger that number is compared to 1/15 of the acquisition, now you're paying effectively income tax on that principal payment. So sometimes I'll see, and that's if it's an asset acquisition. If it's a stock acquisition, which maybe I'll just explain that because it's simpler, if you're paying $100,000 a year or 200 or 400 or whatever it is per year for acquiring a practice, basically you're also going to have to tack on your marginal tax rate of cash out the door in order to make that payment. So for a lot of people, they don't realize that. And so they'll think, okay, yeah, like if the business has, $1 million of profit and I'm going to have to pay 400,000, great. Like that math works for me. Well, it's like, actually, it's going to be 400 plus 35%. And that's how much cash is going to have to go out before you even get your pay. So for a lot of people, that can be a big gotcha when they don't know the mechanics, and just making sure that, is this business actually profitable enough that it can fund its acquisition? Because if it can't, you probably don't have good deal mechanics there. I guess thoughts around that.
Yeah, no, lots of thought. I think the tax impact is obviously important. I think the liability piece, particularly if you're now in
Yeah.
looking at an external acquisition, is even more important. So I typically, and this is outside of wealth management in general, that unless you have government contracts, which RIS typically don't, or there's other unique aspects, I typically highly recommend asset purchase, just from the fact that, say you buy a business today and there was I don't know, a harassment that happened 5 years ago, or a
Yeah.
client that is suing you that you had nothing to do with, you knew nothing about. All of those liabilities will follow you when you do a stock purchase. Well,
Yeah.
if you do an asset purchase, with some exceptions, you typically have a clean slate. So many of those unknowns, you get rid of by doing an asset purchase versus a stock purchase, which can really make a difference if you happen to buy a lemon.
Yeah, no, that's true. And I think oftentimes I'll see, kind of the flip side of this argument of like, well, why would somebody do a stock purchase?
Yeah,
In cases where I've seen it, part of what can force you to do a stock purchase is if you're not selling 100% at once.
yeah,
So I have a lot of people where they'll sell in tranches because they're like, okay, my employee is ready to own 20% and I'm going to have them buy 20% over the next 5 years while I exit. We'll kind of make it a smooth process for me to exit. I'm still getting income. It's cleaner for the clients. We're not having to repaper everything.
yeah.
So I have some people where they'll end up doing that kind of a structure, and we basically have to keep it a stock sale just because it's in tranches. So it just depends. Like it's not a one size fits all, but I think that's why it's especially important if if you're entertaining deals. I always tell my clients, if you're like more than 65% of the way there, like we should do a forecast just so you can see how it's going to flush out on the tax side, just because there's some really big differences depending on structure. And also you just want to know the math is going to work in advance, and then even stress testing it, right? It's like we're in awesome market conditions right now. How much tolerance do you have where the market could go down and this book you're acquiring is still going to be able to pay for itself, right? Because
Absolutely.
at a certain level, if the market recedes a certain amount, your revenue, I was doing this math earlier for somebody. It's like if their revenue went down 10%, their net profit went down 50%. It's a ratchet effect,
Yeah,
and so for a lot of people, you want to know where the lines are, because it's okay, how confident do I feel that this book is actually going to stay at the same revenue level, and what if we see a market pullback?
yeah.
How much like room do I have, right? So that's a common one that we look at too. I guess for to kind of change gears a little bit and a little more like red flaggy kind of things, when you're working with advisors for the first time who maybe have had very little professional involvement on the financials, what are some things that you think every advisor should know about their own financials or should know about the accounting function?
It's a good question. On one hand, you got to know your revenue growth and get an understanding of where the revenue is coming from. Partially because that will also inform you in your business development efforts.
Mm-hmm.
Margins. So most certainly the I guess call it gross margin preferably per client, as I mentioned earlier, but
Mm-hmm.
for sure at the aggregate level. Operating margin, and obviously net income, which is what you take home. But I think the distinction here is profits is not the same as cash flow. So you got to be able to understand both. And this is something that I see again and again, where more so in all the industries than RIAs, because it's a nice business typically from a cash flow
Yeah, it's a
perspective.
simple model. Yeah.
Yeah, it's very simple. It's very simple, and hey, there's no inventory. There's no other complications that yeah, definitely makes profit very different than cash flow. But there are nuanced differences. So I think being able to look at both, profit will inform you on how business is doing long term and is it sustainable. Cash flow is your oxygen from week to week, month to month, and you need to be able to look at both. Not sure if I answer your question fully there, but reading, I guess, taking a step back, read the financials, understand them, make sure they're set up in a way that they help you make decisions, and make sure you get them timely. So you should be getting them within 2 to 4 weeks after a month end. If you wait a quarter or even half a year, you're way far behind on things, and you're basically operating blind.
Yeah, absolutely. And I would say one other little thing that often comes up that I recommend to people, if you can do this, is for a lot of advisors where, funds are coming into your bank account already net of platform fees, going back and adding your platform fees back, because for a lot of people, they can think, oh yeah, like I'm so profitable. But then when you actually, account for the fact that this got a 20% haircut, your profit margin is not as good. It's not nearly as good as you thought it was. So I think that's another one where it can be, it's a very common, especially when people first start, because if you have a bookkeeper who, doesn't know how to do adjusting entries, which is pretty common, or doesn't, isn't able to do accounting, they're able to record transactions, but not able to do accounting adjustments, you'll have a P&L that looks really different than having those platform fees on there.
Good point. And if you've seen $100 on the revenue for you on the P&L, but the client is paying 125, that's really what the revenue is. And you should see, is that $25 difference worth what I'm getting and worth what the client is getting?
Yeah. And the other piece too, and this applies more for the hybrids, or especially firms where there's a significant insurance commissions or insurance activity that gets reported separately. I also find it's very helpful to see that activity at a global level, because oftentimes what will happen is you've got all this insurance, or you've got this brokerage side that for tax, from a tax perspective, it gets reported separately. Yeah. But from a business operations perspective, a lot of times that revenue is being served by, the main operating entity, like your main personnel and everything. And so being able to, include those as well when you're looking at some of this analysis of well, how's the business performing? Because it wouldn't necessarily show up on your P&L.
That's a great point. And being able, and this, you had another point earlier in regards to owner compensation too. And I think both of these points feeds into the fact that having consolidated statements, if there are separate pieces to your business. So on one hand, if you're a hybrid, you got to consolidate the numbers so you can see what part of the business is growing, what part of the business is growing less, which one's profitable, and so on. And then back to the good point you had on owner compensation. If you are underpaying yourself, you think you're more profitable than you are. That's definitely going to be an issue if you're now looking to sell the business, and you have to make some adjustments. But I think just from a clarity perspective, putting into your financials that you do, not for the tax purposes necessarily, but for your own financials and where you make decisions on, being able to see what your market rate is. Meaning, if you stepped out today and you need to hire someone on the market at market rate, what would that be? That will reflect the actual profitability of the business. Think of it as a standalone business that's independent of what you do with your personal finances and how you pay yourself and so on. What does the financials look like for your business?
Yeah. And it's, for a lot of people, you kind of have, I don't want to say you keep two sets of books, but you kind of do. For tax reporting, it's going to show up a certain way with how you report different revenues flows, what you would set your W-2 compensation at, how much, because typically for most people, if you're in an S corporation, we're trying to show as much profit at that level as we can, because it's the most tax efficient, especially too for paying your state taxes through your entity, which most people you want to do in that kind of a structure. But then from an actual, well, what are the operational mechanics of this business? Like you're saying, you need to see, okay, if I'm out of the business tomorrow, what would it cost for this to replace me? And ideally over time, for a lot of firm owners, you want to see that number kind of go down. If your participation in the business, it's less and less dependent on you over time. Yeah. And it's okay, if I walked out of the business tomorrow, we actually have internal capacity that, my team could pick it up and they don't need me. I wouldn't have to replace myself, So it's nice to have, it's a joke that I make, like a business that's nice to sell is a business that's nice to own, So
Yeah,
if you make that business more resilient, where you don't have that, what we call key man risk of, okay, if you go out for a 6-month vacation, is this business going to continue to grow without you and be functional without you? It's not that you have to do that, or it's not that you have to sell, but if you're in that kind of a mindset, it'll help you focus on the things that are going to make the business a better asset for you as an owner as well.
exactly. No,
Yeah.
it's
So I guess
yeah.
go ahead,
Sorry.
Max.
No, I was going to say, yeah, even if you don't want to sell, whatever you do to create more value in the business is good for your business nonetheless. And to your point, it de-risks us as well. So no,
Yeah.
it's yeah, some good points.
Yeah. So I guess before we go, are there any final thoughts that you have, Max, that you want to share with the audience before I ask you to talk a little bit more about the work that you do with firms?
So I think we touched on it already, the importance of understanding the cost to serve. It's critical in the RIA industry.
Yeah.
If you look at the P&L, and we keep talking about the P&L, but both of us know that the balance sheet is just as important, so I don't want to ignore that. But if you look at the typical RIA P&L, 2/3 goes to payroll, and then a sixth to a quarter is operating profit, and whatever is left is rent, technology, marketing, and so on. But even though you should look at those costs as well, the one that really matters is the payroll.
Yeah.
And it goes to both sides of it. It's both the biggest cost, but I dare to say it's also your biggest asset. So you got to have a good grasp of how it's being used. So yeah, that would be my parting thoughts on what's needed, what's important to look at.
Yeah. And it's funny, like we didn't really talk about the balance sheet, which that's like a whole other episode of balance sheet issues. And for a lot of people, they don't realize that the balance sheet is really the mirror of your P&L. So if there's issues on one side, there's issues on the other side. But I would agree. And something that can be a little tricky is, you see this big payroll expense number, but like you were saying, if you know the cost to serve, roughly how much of an asset that actually represents, like the revenue generating and the profit serving capacity of that payroll expense. Like it's kind of a bit of you have like these phantom assets on your balance sheet, so to speak, of what you've built up over time in terms of efficiencies and systems and people, brand power, just whatever, right? Like these are all going to be assets that don't get reported on your financials anywhere because they're self-generated and a lot of them are intangible. And so having some of that unit economics information around like, okay, how efficient, what's my labor efficiency ratio? That's going to tell you how much of an intangible asset that you've built up over time. So that can be really helpful. So I guess a little bit to dive in a little bit, Max, for people who don't know what a fractional CFO does, or for, something that I'm encountering, and it's very true on my side of the fence as well. People who say that they're, tax planners, but it's actually like kind of scammy. There's been a proliferation in the field of people who call themselves fractional CFOs, but don't actually do CFO work, which is very specific. Could you describe a little bit around like what is a fractional CFO? What do you do with clients? What should they be aware of kind of the work that you do?
Yeah, and it's a good point because you do see a lot of not only some in the wealth management maybe, but more so outside of the industry too, where a lot of bookkeepers who are doing a great job, but they're not calling themselves fractional CFO at a higher margin. And that feeds back to a little bit of negative publicity. But how I view the CFO is basically more on the strategic side. So I typically come in when a firm has outgrown relying only on their bookkeeping and accounting, to some degree also controller function, but they're now big enough to justify hiring a full-time CFO. So for me, that in the RIA space, that's typically 350 million to 5 billion in AUM, or like 10 to 75 employees. I can't do a good job without a good bookkeeper and accounting team. So, and I don't do taxes, so I don't dare go into that. I know enough to be dangerous, but I rely on experts like you for tax advice. but it's basically the strategic part, and moving the business from only looking backwards at your books, which is also important, but now using those books today and how it's been historically to start looking forward and making decisions based on it. So it's much more on the strategic side, has to dig into how do we actually go from today to financially, where do you want to go 5, 10, 15 years down the road. M&A is a big one. So we're helping owners go through the process, not only do the due diligence and the number crunching, but also being a strategic sounding board and look out for the red flags as you go through an acquisition. I do help a little bit on the exit side as well. And then you have things like debt capital, equity capital, and improving that part of the business that becomes more and more important as you grow. But yeah, strategic rather and forward-looking more than the accounting and bookkeeping, which again is critical as well, but complementary.
Yeah. Oh yeah, and it's I always joke, like, I can't tax plan on a spaghetti. Like, I need I need correct financials. And then also, a challenge we have is most people don't have an FP&A function. So, when I ask them questions like, so what do you think revenue is going to be this year? It can tend to be a number pulled out of a hat, or just like, let's do 10%. Like, which at certain levels of business complexity are fine, when you've got a really closely held operation where the owner is the main advisor on all of the accounts. They're still very involved. They don't have a big team under them. So, it's funny, like, as you go through these different phases, it really, the nuance of what you need and what you need to see, it really, changes over time. And I really appreciate, your focus on the strategic element of it, because I can find with a lot of people, they see the financials as this like necessary evil that's required for a compliance standpoint, but don't really understand that once you've got the process down and you've got a lot of these metrics down, you really do have visibility to make decisions. And a lot of when I'm talking to advisors and they're saying, well, I don't know, like, should I hire the next person? Or, I don't know if I should acquire another business or not, or I don't know how much I should invest in the marketing or where that should go. A lot of those questions are just finance visibility issues, right?
Absolutely.
And it causes a lot of anxiety, I think, for a lot of advisors. And they see a lot of these kinds of questions as, well, I'm just going to have to go off of my gut, when in reality, you could actually break down a lot of this into data. And if you have things like your individual cost to serve and your capacity, when to hire the next person, because you have, unless you've got a way out of norm, like whale client that comes in, for the most part, you generally know, okay, if we close this many new households and it takes this many months to ramp up this kind of advisor, we need to hire for this next role by this time, you can do a lot of that math, and then it doesn't become well, can I afford it? When should I do it? How should I do it? Like, a lot of those questions you can answer just from your data. So it's a really important function. It's especially having it be strategic, which I think a lot of people don't. They see fractional CFO as like, kind of, this is how the business did, but it really is, I see it kind of the same way as you, where this is pricing strategy, talent strategy, really all of the operational elements of the business through the lens of the real data, because you can have all these initiatives and all these goals and all these things, but if it's not actually, brought down to the level of, the dollars don't lie, like you can, I have a lot of advisors that I bump into where they have certain feelings about their own performance or feelings about their financials. And it's like, the data doesn't lie, but the feelings can lie.
Yes. So. And if it backs it up, then it confirms it. But
exactly.
And you touched on something here in terms of goals. And that's, I think, is I forgot to mention, an important part of a CFO role is, a lot of businesses have say 5 or 10 year revenue goal. Fewer than them tend to break it down into, say, EBITDA goal or valuation goal and so on. But I even more rarely see businesses tie their goals to today's financials. And it's not rocket science, but basically having a three-way financials, meaning you have your P&L, your balance sheet, and your cash flow statement linking today to where you want to go in the future. That gives you a roadmap on how to get there. So it's not some far out in the future revenue goal that we're going to hit. And even if you hit that revenue goal, if you didn't think about it from a profitability perspective, you may be in trouble before you get there. So being able to have that, now you have a roadmap, you're navigating the different obstacles that pop up every once in a while, as all entrepreneurs know. And you can simulate with it. So to your point, hey, does making this new hire make sense? What is opening this new location or acquiring this practice going to do, not only to my financials, but ultimately my future goals? Is it getting me closer to it, or is it taking me on a different path? So it's to many it sounds like a big undertaking, but having that link between today's financial and your future goals isn't necessarily as much effort as many people think it is.
No, and a lot of it's just systems engineering, right? Like, most of the tech stack that people are using now, like, this data is already being collected. Like, everything's already happening on a digital platform somewhere. So it's just a matter of getting the right systems to be set up to produce the right, where you've got the right inputs and outputs, where, okay, let's collect all this. I'm sure you do the same as we do. It's like, we just got to engineer some nice Excel spreadsheets and you can get kind of whatever you want. And it's like, it's not a big deal, and I think a lot of people see it as like, oh, this is going to be some crazy process, but it's more important that you need the systems engineering and you need somebody who knows how to engineer the system so that it's producing what you want. And you need it, this is another thing I usually say for most advisors, like, your financials process should be something that happens automatically and independent of you. Because if you're like in there in the kitchen, in the QuickBooks or whatever it is, like, that's not where you want to be. Like, it just needs to be a function that runs in the background, that's served to you. And then you just kind of, when you're going to spend your, if you've got so much of a attention/hours budget for it, you want it to be at the strategic discussion and future planning review mode, not the, I'm going to try to chase down this $50 that didn't reconcile, right? So,
and there's a important difference there too, in the way you want your books to be as good as possible. You want, close to perfection in many ways. Not full perfection necessarily, but they need to be accurate and they need to be solid processes. And we're operating in a world where closer to 100% is good. But when you shift to looking forward, that's a whole different role. And that's where the CFO role comes in, where nobody has a clear crystal ball. So we operating on much less certainty, but still making no decision is also a decision. So now you're taking good financials. So that gives you at least the backing, but you got to combine that with strategic insight. So not only looking at the finance function, but also the operations, marketing, regulatory, and so on. Along with, I say judgment, which is hard to define, but critical in order to be able to make financial decisions for the future. Again, backed on good financials, but much less data certainty than if you just look at the books.
Yeah, and zero certainty if you don't do anything with it, which is what.
Exactly.
It's like something's better than nothing. And, especially when you mention like the unit economics and the cost to serve, like, just that alone, like, for so many people, if you have that process in place, like, it's going to get you a really good amount of distance around what do we need to be working on. Yeah. Getting
you 60 to 80% is way better than nothing. So.
Oh yeah, absolutely. Well, thanks so much for coming on the show, Max. I really appreciate you coming on. For those of you listening who are interested in learning more about what Max does, I'm going to have in the show notes his contact information and how to get in touch with him to learn more about how he works with firms. But I want to thank you again for coming on the show today. It was great. It's always fun for me to have another financial professional on here.
Thank you. It was an honor to be here. Had a great time. And I'm a big finance nerd, so love this. Thank you.
So for those of you listening, I'm always interested in getting feedback on the show. So let me know what you thought. And then if there were certain topics or issues that you found particularly interesting or places that you'd like to see a future episode about, send me a note and we'll put it in future ideas. So thanks, everybody. Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.